Welcome to my channel, where I talk about AI, tech, and the stock market daily. Today, I wanted to dive into the challenging landscape faced by German automakers as they grapple with the explosive rise of electric vehicles, or EVs. This shift isn't just about a technological evolution. It's reshaping global competition, altering supply chains, and even testing the resilience of some of the world's most prestigious brands like Volkswagen, BMW, and Mercedes-Benz. In this analysis, we'll explore how German automakers, once considered the pinnacle of engineering excellence, are struggling to adapt to an electrified future, all while contending with fierce competition from Tesla, Chinese EV giants like BYD, and ambitious startups. We'll look at how these dynamics are reflected in sales data, profit margins, market share trends, and, most importantly, the evolving expectations of global consumers. To understand the depth of the problem, let's first acknowledge the rapid rise in EV adoption globally. In 2024, EVs are on track to account for nearly 20% of new car sales worldwide, a sharp jump from just 4.2% in 2020. In Europe, the numbers are even more striking. EVs and plug-in hybrids now represent over 30% of total sales. Germany, traditionally Europe's largest automotive market, is witnessing an acceleration in EV adoption thanks to strict emissions targets and generous government subsidies. Yet, despite these favorable conditions, German automakers are seeing their market share dwindle, with Tesla dominating premium EV sales and Chinese brands gaining traction in the affordable segment. Volkswagen, Germany's largest automaker, has been particularly vocal about its EV strategy. The company has invested over $50 billion in electrification since 2019 and launched its ambitious ID series to compete with Tesla. Yet the numbers tell a different story. In 2024, Volkswagen's EV sales, while growing, are lagging behind projections, with the ID.4 and ID.3 struggling to gain the same kind of brand loyalty that Tesla enjoys. Compounding the issue is the downward pressure on margins. While Tesla consistently posts profit margins exceeding 15%, Volkswagen's EV margins hover around 6%, barely offsetting the steep development and battery costs. BMW and Mercedes-Benz, known for their luxury offerings, are also under pressure. Despite launching competitive EVs like the BMW i4 and Mercedes EQS, these brands are fighting an uphill battle against Tesla's Model 3 and Model S, which continue to dominate the premium EV segment. In 2024, Tesla's Model 3 outsold the BMW 3 Series globally, a symbolic blow to a car that had been a benchmark in the premium sedan market for decades. Meanwhile, Mercedes EQS, while technologically advanced, has failed to achieve the same sales momentum, with critics citing its high price and lack of differentiation compared to Tesla's offerings. One of the biggest challenges for German automakers lies in their dependence on traditional internal combustion engine technology. For decades, Germany's engineering prowess was centered around developing highly efficient diesel and gasoline engines, a focus that is now becoming a liability. Retrofitting existing factories for EV production has proven costly and time-consuming, while Tesla and Chinese rivals, unburdened by legacy infrastructure, can ramp up production more efficiently. For instance, Tesla's Gigafactory in Berlin, operational since 2022, is churning out Model Ys at a fraction of the cost it takes Volkswagen to produce an equivalent EV. Adding to this, supply chain disruptions and the rising cost of raw materials like lithium, cobalt, and nickel are disproportionately affecting traditional automakers. While Tesla has mitigated these challenges by securing long-term supply agreements and developing its own battery technology, German automakers are heavily reliant on third-party suppliers. This dependency not only inflates costs, but also limits their ability to innovate at the same pace. In 2024, Tesla unveiled its next-generation 4680 battery, promising higher energy density and lower costs, further widening the competitive gap. Then there's the Chinese factor. In 2024, Chinese EV brands like BYD, NIO, and XPeng are aggressively expanding into European markets, offering high-quality EVs at competitive prices. BYD, for example, recently surpassed Tesla as the largest EV manufacturer by volume, and its expansion into Germany has been met with strong demand, particularly in the mid-range segment. German automakers, with their higher cost structures, find it difficult to compete on price without sacrificing quality or brand perception. This is particularly troubling for Volkswagen, which has historically dominated Europe's mass market segment, but is now losing ground to BYD's affordable, yet feature-rich models. Another critical issue is software. As cars become increasingly defined by their digital capabilities, German automakers are finding themselves outclassed by tech-savvy rivals. Tesla's autopilot and over-the-air updates are industry benchmarks, while German automakers are still grappling with software bugs and delayed rollouts. Volkswagen's much-hyped Cariad software division, established to develop proprietary EV software, has been plagued by delays and cost overruns. In 2024, the company announced yet another setback in its autonomous driving project, prompting CEO Oliver Blume to acknowledge the need for external partnerships to stay competitive. The challenges don't end there. German automakers are also facing mounting pressure from investors and regulators to accelerate their EV transition. The European Union's decision to ban the sale of new internal combustion engine vehicles by 2035 has left little room for error. At the same time, activist shareholders are demanding more ambitious climate targets, further straining resources. In 2024, Daimler announced a plan to spin off its trucking division to focus exclusively on EVs and luxury vehicles. A move that was met with mixed reactions from analysts, who questioned whether the company could balance long-term investments with short-term profitability. So what's the way forward for Germany's automotive giants? Some industry analysts believe that consolidation is inevitable. In a crowded EV market, smaller brands or those with niche offerings may struggle to survive, making mergers or acquisitions a likely scenario. Others argue that partnerships with tech companies could be the key to closing the software gap. For example, Volkswagen's recent collaboration with Qualcomm to develop autonomous driving solutions could serve as a blueprint for future alliances. There's also a growing emphasis on vertical integration, particularly in battery production. BMW, for instance, has announced plans to build its own battery factory in Hungary, aiming to reduce dependency on Chinese suppliers. However, scaling these operations will take years, and in the meantime, German automakers risk falling further behind. At the consumer level, brand loyalty will be critical. While German automakers still enjoy a strong reputation for quality and performance, they must ensure that their EVs deliver on these promises. This means not only matching Tesla and Chinese brands on price and range, but also offering superior driving experiences and after-sales service. In conclusion, the rise of EVs is undoubtedly a transformative moment for the automotive industry, but it's also a daunting challenge for German automakers. Companies like Volkswagen, BMW, and Mercedes-Benz are facing a perfect storm of competition, cost pressures, and technological disruption. While they have the resources and expertise to navigate this transition, the clock is ticking. The next few years will be crucial in determining whether these automotive giants can retain their leadership or become cautionary tales in the age of electrification. If you enjoyed my analysis, please subscribe to my channel. Thank you, and see you next time. Remember, while these insights provide a comprehensive overview, they are for reference only, and I am not a licensed financial advisor. Markets can shift rapidly, so always do your own research before making any investment decisions.